Well, hello, everybody, and welcome to Wealth Wednesday and Real Secrets of Money. Today, we are going to talk about maximizing your money and gaining some efficiencies there, and specifically doing some deep dives into the savings and your money mindset. My name is Lisa Lickert, and I am your host for today, and it's all about you in this session. So if you ever have any questions throughout, we'll try to have some time at the end for questions for sure. But if something pops up along the way, Yarnita is managing our chat. She will get your question in the chat and she will make sure that she brings it to my attention. We will talk about it, answer those questions as we move along. We have customized today's session based on your survey answers in the registration process. We've also added in some trendy topics that people like to talk about and those questions that are common with our clients. So without further ado, we're going to get started today. And we're going to get started with a question. So this is our first polling question. It is very interactive. We really want everybody to participate as much as possible. The more you participate, the more you get out of it. And so we're here to serve, educate, and empower. What we always say is that if we've given you enough information to make a decision on your own without us, you're going to want to make that decision with us. So we are definitely focused on education. Now, what influenced or had the greatest impact on your money mindset? Where do you believe your roots came from? Was it your family? Was it the culture, community that you were raised within? Maybe school, what it did and didn't teach you? Maybe your personal experiences, or all of the above, kind of the combination of everything. We're getting some answers in here on the polling questions. Got a few people. Let me see here. A few more people I think need to jump in. Yes, yes, yes. Okay, we are going to close out the poll, and we're a 50-50 split. So we have half of the folks that are joining us today are really sharing their thinking around how what their family influenced. So what they've learned and observed as they were growing up played a big part. And the other 50% of participants today feel that that combination of all of the above, so their experiences, their community, their family, the schooling that they received. And so that's really interesting as you kind of think about the roots of your money mindset. So put that in your back pocket, because we're going to pull it back out here later on as we discuss today's topic. All right. So the next question that I have for you, and this is a little exercise to do on your own, definitely not a polling question. Grab a piece of paper or keep it top of mind. We're going to pull this out later on today as well. And that is, what is the one adjective that you would use to describe how you feel about money? So maybe it's when you are talking about money. Maybe it is when you are dealing with money, having money problems. So what is that one adjective? And I'm going to ask for a brave volunteer to drop in the chat what that one adjective is. Oh, and I think we have a question. Not sure how to answer the second question. Are you referring to the slide that we're currently on right now? No. Okay.
We can take that offline, Lisa. I know exactly what she's talking about.
Okay, awesome. Let's definitely do that, so we can chat very individually and speak about very specific situations. Okay, we do. We have anxious. All right, we have anxious. Anybody else? Overwhelmed. Yep. That's pretty common. That's pretty common. I hear you. All right, set that adjective aside, whether it's on a piece of paper or it's in your mind. Just kind of set that aside. We're going to come back to it here in a little bit. Now, the reality is here is how we live. There's really only three categories or three different ways that you live. You live beyond your means, you live within your means, or you live below your means. And so that's just, it is what it is, right? And so be very critical of yourself as you're absorbing this information, and we're having this discussion today, and slot yourself into one of these ways you believe you are living today. All right. So to maximize your money and gain efficiencies within your money, it's extremely important for you to have some of this pre-work, better understand kind of where you came from on your money mindset, understand how you feel when you think and you think about money and deal with money, because it is really important to understand those things about yourself, or this is just a bunch of words, right? Because you really need to be able to understand how to maximize your money in your specific situation. And a lot of people feel helpless. They feel like they need to earn more money in order to get where they want to go. But the reality it is, many cases, maximizing your money and gaining efficiencies in your money is what has to happen first and foremost. And in some cases, you can still map yourself into where you want to go without additional income. So 3 components of a savings plan. The first and very important component that many people miss out of their savings plan is having that emergency fund. So having some money somewhere to pull from in case of emergencies. And then your short-term savings. This is we'll talk a little bit more about this, but this will be more like your home repairs, maybe vacations. And then that long-term savings. Many people think about retirement for sure, but this is also things like coverage for medical expenses as we age. So targeting your emergency funds, what you really want to do is understand how you're living today. And if something happens to your income, how you would live tomorrow. And so you really want to understand your expenses here specifically, so you can cover those expenses first and foremost with that emergency fund. We'll talk a little bit about the longevity of that emergency fund here in a second. The short-term expenses, you really need to get honest with yourself and make sure you understand, does the water heater need replaced in a couple of years? Get real about some of those short-term expenses, because it probably does. Maybe your windows are want to right now, but in 5 years, they're a have to, right? So something along those lines you're thinking of for your short-term expenses. Your long-term expenses and savings goal is usually around 10%. If you haven't had that 10% in your life for quite some time, we're going to be thinking about ways that you can, what I call find money, which is sometimes comical to put it that way, but find money to start to recover for those years that you weren't saving as you should, but really talking about where to place that money as well so that long-term savings can be maximized. Let me see here, just double checking. We're good on the chat. All right, we've got another polling question. So when you take a look at your savings strategy, how would you rate yourself? Do you feel that you have confidence around your strategy today? Is there a clear strategy and you know where your money is and how it's working for you? Are you somewhat, not very, getting started, or really just not sure how to think about things because you haven't necessarily had the opportunity to look at your money in this way? Okay, so got a couple more answers coming in here. Okay, here we go. Here we go. Nice. Okay. We're going to end the poll, and I'm looking at my separate screen, so sorry if you see the side view of my face, but we're going to end the poll, and we have 30% of our participants are very confident. And so that is like super exciting. That is something that I love to hear, because at this point in time, the making your money work has a little bit more sophistication and a little bit more depth in your strategy to make that happen. A lot of times we're really leaning into more tax strategies. We're also leaning into some features that are available in financial products to make some things happen for you. We have 20% that are somewhat confident, so they have some foundation, maybe some feeling that I've done some things right. I've got some confidence behind it, but I can always learn. I can always do better. We have some 10% not very confident, 20% just getting started, and 20% I'm not sure. So when you take a look at those categories, some things like congratulations for being here, because understanding that you have some weaknesses or some opportunities in this area is your first move. So that is so cool that you're here today, trying to learn, trying to figure it out, being a part of something like this so you could grow yourself, your money, maybe your financial acumen. So that's all really cool stuff. All right, let's do a deeper dive into that emergency fund now. Awesome sauce. So let's do a deeper dive into emergency fund. And so the best practice is having 6 months of your monthly expenses. But the reality of it is you really need to think about what that 6 months looks like. Like I mentioned before, 6 months of your full expenses today is a pretty large, probably much larger than what you can get by with for 6 months if something happened to your income, right? So you really, again, want to get very clear on what those wants and needs are. We'll hit on that here in a minute. And in order to kind of create that foundation for your emergency fund. But once again, let me go back here. Here we go. But once again, 6 months may or may not be enough. So if you think about your industry that you work in, if you think about maybe the company that you work for, it might take a little bit longer to find that next job, to find how you're going to replace that income that has been lost. And so you really need to think through that as well. And so that could mean that your emergency fund is 9 months, not 6 months. So it's a lot of money for many people to think about in that emergency fund, but it's something that is important to do and be very specific about in your situation, what it would take to float 6 to 9 months of expenses in case something does happen in your life. So it's not a rainy day fund, which a lot of our clients share that they have 6 months of emergency fund. But what we find, they're blending that emergency fund with that short-term savings. And so if you have real clear budgets and understanding of what your money's doing for you, that could definitely work. So that's not a slap on the hand at all, but we do caution and really focus in on what that emergency fund is for. So emergency fund is not for buying a new couch, splurge, splurge. You just found a great sale, you can't pass up. Or maybe some annual planned expenses. I know HOA fees or things like that. Sometimes people will tap into their emergency fund. This is truly for those emergencies. Your income goes away, something happens to you. So you have those insurance deductibles, you have the medical expenses, something happens to the kiddos. Your primary vehicle completely gives out on you. Those types of things. So be very critical of what you are calling your emergency fund and what that fund is doing for you. It is not for, home renovations, those types of things. Your needs and wants, sometimes these are pretty obvious to some people and sometimes they're not as obvious to others. So it's just really good to get this in front of you and be mindful of it. My favorite 2 bullets on here is what you need to make informed decisions. We talk in other sessions and in our one-on-one coaching sessions a lot about understanding that opportunity cost. So if you choose to do this with your money, what are you giving up over here? And so when you understand your wants and needs, it's really important for you to also understand what want you have to give up for your need over here, or what want can you pursue because you have understood your opportunity cost. And so what are you giving up to get? Budgeting is a critical part of that foundation, and finding the right budget that fits your money mindset is equally as important. It can jeopardize your financial goals. It can absolutely derail you in the wants and needs scenario. I smile on this slide a lot because how cluttered is our world. You go online and everybody's marketing these things to you. You're scrolling social media and you're buying a pair of shoes you didn't plan. You are seeing everybody's post or everybody's videos about their fabulous, incredible home that they're in, and they just bought a home 3 years ago, and now they're upgrading to another home. Our culture is excess, and so it's just very difficult to ground ourselves in wants and needs when that is thrown at us all day long, every day, from every angle. So when you think about your shelter needs, be conservative. Your shelter is having that roof over your head. It's not getting the bigger house, the newer house, the bigger yard. Your needs are really, you want your quality of life for sure, but you have to understand what your goals are to determine what that quality of life is. And when you're talking about making your money work for you, the decision in your shelter is your home is going to play a very big part, because that's a significant expense. And if you're putting it in the needs category or the wants category, that does impact things like your long-term savings. So shifting to the long-term savings piece, here it is some of the obvious things. What is your employment risk? Is the industry that you're in, is it, is there a lot of movement in the industry? Are you finding that the company that you're working with is doing some consolidations, or they are right sizing, and you're seeing that different departments are maybe reducing staff and those types of things. So when you're thinking about the long-term savings, you're not only thinking about how you're getting money into accounts that are going to work for you long-term. So when you want in retirement or end of life, you want to have a certain lifestyle, you have to think about what's happening right now in your world, right? So if there could be some risks within your employment, for either potential unemployment or some shifts in income, ability, and opportunity, that's something to think about as well as you're considering your long-term savings. Again, you want to make your money work for you, and you want to make sure it's in the right buckets, and you want to make sure that you're thinking more long-term, of course, not just short-term. Family responsibilities. So how many of us take care of our parents? How many of us take care of our grandparents? And we absolutely love them, so we do it. But how expensive is it? So how expensive is it for their medical care? How expensive is it because you have to take time off work? And so thinking through those medical expenses and the sacrifices we're making for our family, do we want our children and grandchildren to do the same for us? And so those are the realities that we face. That is something that we talk a lot about in our planning sessions. Debt management, wah, wah. So this is just a thing. It's a thing in everybody's life. There's good debt, there's bad debt. That's another session that we do, debt and loans, and something that we have a couple of videos on our YouTube channel about for sure. And we talk a lot about it with our clients as we're doing our roadmaps and strategy sessions. And so debt management is extremely important to your investment fund future, as well as your current day short-term savings. And it's something I just threw a couple of slides in here. And the first one is on debt. I'm just curious to know, of those that are joining us today, what do you consider a good debt to income ratio? So as far as your income that you bring in, and then the debt that you hold. Is it 0 to 20%, 21 to 35, 36 to 45, or 46 and higher? What is considered a good ratio? We'll go through the ratio here in a second. Okay, guys, let's refocus. We're recording today's session. Let's focus on the poll here real quick. And if you have any questions, instead of unmuting, please drop them in the chat. That way we can control some of the recordings for YouTube, and we can make sure we get to everybody's questions. All right. So we have 67% of people that are attending today believe that 20% or lower is a good debt to income ratio. 21 to 35%, we've got 22% of our attendees, and 46% or higher, we have 11% of our attendees. So a good debt to income ratio really needs to stay below that 36%. And depending on who your lender is, that could be still considered very high. So around 25% is where we recommend our clients manage their debt to income ratio. Now, it's going to go up in different stages of our lives. It could be something relating to things like college savings and maybe college loans. It could be things where we're buying a home and maybe a car at the same time, so our debt to income ratio is out of whack. But managing it below that 36%, you're typically going to find that if you have a need for additional debt, you can access that. But the issue is the good to bad debt ratio. So again, in our debt and loans session, we do hit on this a little bit harder, so I'm not going to cover it here. But just doing the basic calculation, we provided a sample calculation of how you come up with your personal debt to income ratio. And we encourage you to do that and become very aware of what that is. So where do you put your money to maximize it? So lots of options here for sure. Let me give you one example. I'm going to give you this example, and I'm going to do it in reference to the cost of money as well as your short-term savings and your emergency fund. So many people got your bank app, and you have a savings account in there. Some people might have a checking account that they call a savings account, but it's separate from their day-to-day account. What we encourage people to do is really kind of think about the way they place their money differently. So for example, your high yield savings account is probably one of the easiest examples that we can give folks that are on for today. Depending on what type of what savings account you choose, you could be earning 4 to 4.8% on your money. Now that's without transaction fees, that's still with FDIC approved, that's still accessible liquidity of your money, but it's 4.8%. And how many people on today have growth on their money in their money market or their traditional banking account getting that? Not many. It's very, very rare. And so when you're thinking about saving 6 months of your emergency fund, and you have to save for your short-term expenses and repairs on your home, where do you want to place that money? Do you want to place it in your bank account that maybe gets less than 1%, or your money market that gets a couple of percentage points? Or do you want to place it in a high yield savings account? So, and make your money, maximize your money, make it work for you. Another thing using a high yield savings account that we really like to give examples on, it's kind of a nice way to relate to what we mean when we say cost of money, is purchasing a car. So when you purchase a car, there is always a consideration for what that down payment is going to look like. And so when you look at that down payment, you want to look at what that money is earning versus what that money would do for your car loan. So for example, using the high yield savings account at 4.8% and using a car loan at 3%, would you put a down payment on that car loan based on the cost of money of 3% and the growth rate of potentially 4.8%? So you can kind of see how you make your money work for you, make it more efficient for you. You're still going to buy that car. You're going to still have that same dollar amount for the down payment, but where do you shift it? Do you shift it to the car down payment, or do you keep it within the high yield savings account because of the interest rate? Another example would be things like annuities and insurance-based strategies, which is really at the core of what we do to diversify our clients' portfolios. People have no idea what these financial vehicles can do for them. So we're always taking a closer look at their goals and objectives for themselves and their families. And we're mapping people into financial vehicles that they may never have even known are available to them. And some of these vehicles even do things like create individual pension plans where you can't run out of money in retirement. So it's really about figuring out what those three buckets are, right? Your emergency funds, your short-term savings, your long-term savings, and then taking a closer look at your options of where you place your money and how you use your money. All right, so we talked at the very beginning about where you feel your biggest influences were that shaped your feelings and your beliefs about money. We also talked about that adjective. What was the one adjective you would use to describe yourself? And so now you're pulling those two things together and you're identifying a category that you fall in, a descriptive category of your money mindset. So of the choices, now there's more choices, but of the choices that we have here today, if you're brave enough, plop it in the chat. But of the where you are today, what would you categorize your money mindset? Oh, you can't choose all the above. You got to get yourself in one category. So use your adjective. That will usually help map you into your money mindset. Anyone else brave enough? Security seeker, we've got a dreamer, love it. Security seeker. So if you are overwhelmed, typically you're going to be in the avoider money mindset because you're so overwhelmed that you don't know where to get started. You might be avoiding some of the things that you need to do with your money. You might be a little bit stressed, so you're not sure, really kind of how to categorize your money. That's what I would suggest that you fall under is more of the avoider. Got a risk taker, we got a giver. I love it. I love it. Okay. So keep that in mind. Here we go. So the important part of maximizing your money and gaining efficiencies is budgeting. And that's another wah-wah. How many of us online today in this room have started and stopped a budget? Maybe multiple times. Maybe they have a budget. You're not even following it. You're not consistent. Maybe you are hitting it out of the park now because you found the right budget. So the point here is that you've identified your money mindset. You identified the biggest influencers. You have an adjective around it. And so really bring it together and choose the right budget system that's aligned with who you are and how you think about money. So we put a little grid together for you. And so let me see here. We had avoider. Yes, we had avoider. Did we have spender? We may not have had spender, but we definitely had avoider. And I think a lot of people fall into this category, but maybe not necessarily understand that they do or not willing to admit they do. I was an avoider for many, many, many years. And what you need is something that's automated and simple, and you need to pay yourself first. So another budget template or budget method is that 60-20-20. But pay yourself first is usually the best way to get started. And it's exactly what it sounds like. You can go online, you can find some apps that really align for free with any of these budget templates. You can also go, there's a YouTube video on everything, as you can imagine. And then in any type of one-on-one we might have together, or the person that invited you have with you, we're definitely going to do a deep dive into the budgeting. We also have budget workshops that we do as well. So you can always feed your desire to learn more about your budget template for one of those places. But pay yourself first is setting up something. Usually it's the high yield savings account that we just talked about. And automatically you don't touch it, you don't see it, you move money into it. You start small. You could start $20. You can start 25 a month. You can start wherever you feel comfortable in your current day spending and earning. Okay. Can you pay yourself first? So knowing that you avoid money, you're overwhelmed, you're stressed, make it simple. And that is the easiest step that anybody can do that is free to make it simple. Make sense? Okay. Let's go here. So some more examples. We've got the planner. Zero-based budget is great for the planner. Every single dollar is accounted for. At the end of the month, you've got big goose egg because you are a planner. You can set your goals. You can march towards those. You love having every dollar knowing exactly where it goes. So you can see where a zero-based would work. 50, 30, 20 would work as well. 50 for your expenses, 30 for your wants, 20 for your savings. You have that control that you desire. Make sense? The giver, value-based budget. If you're a giver, I did see, I think, a giver dropping in the chat there, but if you are a giver, you're going to categorize what's most important to you. In the giver budget methodology or the mindset, typically you give to your church first. And so you're going to have at the very beginning of your month, you're going to have what you are allocating to your church or your family. It could be something, it could be a passion or something that is very important to you and your family. And so you're going to budget around that. There's still your wants and your needs for sure, but that's an example. All right. I think I gave enough examples.
Lisa, I'm sorry, Michael raised his hand.
Oh, okay. So no question in the chat. Just want to, okay, Michael, what do you have for me?
Hey, I just wanted to say, I used to go to church regularly and they took a lot of donations. It was quite, it was one of those churches where, it just felt like I was giving and giving and giving and not really receiving. And I realized that's a lot like my life. I give out a lot of money to a lot of different things and I never retain it. So using what you're giving us today is really helping me visualize how to retain all of my money. Because beforehand, I'm a recovering alcoholic. I used to spend a lot of time just drinking and writing. And I finally got myself sober for 12 months now.
Congratulations.
Yeah, it's really difficult, but I got through it. And I'm only 18 years old as well. I started drinking when I was 16.
Mm-hmm.
Spent all of my money. But yeah, I just thought I'd let you guys know.
Well, I really appreciate being so open and honest with us, and congratulations. It's one day at a time for sure. And you have such great awareness around what's going on in your life. So I'm just honored that you came on and thank you for being so open and honest. And it really is about matching your money mindset, in your priorities to the right methodology. And that's how you do gain efficiencies and maximize your money for your long-term benefit. There has to be a win-win scenario for sure. And if you didn't feel that before, but you now have a pathway where you can pursue that, I am thrilled to hear that. So thank you very much for speaking up. All right. So steps to savings, they are clear to many people, but just something to really kind of keep on track with, right? Start out prioritizing your goals. We do a simple kind of checks and balances on goals and concerns at the start of our discovery sessions, our one-on-one sessions. And it's hard for people to understand what those goals look like. So it's usually more of a conversation. But understand your goals and prioritize those goals. And then 2, you're going to find that right budget methodology, and you're going to use that adjective. You're going to use the influencers that you grew up with, and you're going to get real about who you really are with your money and find that right methodology in order to match yourself with the right budget. Because once you do, incredible things happen. And whether you're looking at your emergency fund, your short-term or your long-term savings, that budget is the foundation of your success. Automate, automate, automate. No matter what your money mindset is, and no matter what your history is, make life simple for yourself. If you're constantly having to touch it, think about it, you're going to be stressed about it. And that's not the way to maximize your money. So when you automate as much as possible, that typically will help you probably exceed some of those goals, not just meet them. And then track and adjust. If you need an accountability partner, get one. Get a friend that might struggle with money, or get a friend that has exceeded in that space to help mentor you. But get an accountability partner that can be really open and honest with you and give you that tough love. The more you talk about it, the more you're going to stay on track. If it stays up in your head, or you only know about it, your family doesn't, your friends don't, they cannot help you succeed. And then know how your money can work for you. Make sure you know if it's a want, if it's a need. Understand whether it's with a financial professional or something that you really want to learn on your own, but understand where it should go. We obviously recommend that you meet with a financial professional to map that out. And then you always are looking at ways to make your money work harder. We think we know what's out there and what's available, but we probably don't. That's the whole entire reason I entered into this industry, is because I was fascinated by some financial opportunities that I had no idea even existed. So keep your eyes and ears open and always be learning and understand where the growth can be, where the tax benefits can be, how do you protect, what's the fee structure, and just be a forever learner. So today's session, just as a reminder, we leveraged the real secrets of money on this Wealth Wednesday, and we focused in on the savings component of that financial literacy program. We added to today's presentation by getting your survey answers and making sure that we were talking about the things that were important to you. We also know what our clients ask us about all the time, and we threaded through some of that information as well. Disclaimer, this is not something where we feel like you can take this information and run with it independent. It definitely will need additional research on your part in learning. And we recommend that you do schedule a conversation with either whoever invited you to today's session or someone from the team. This is a disclaimer from First Financial Security. They're our insurance broker that we work with that did build the Real Secrets of Money session. Now that's all of my disclaimers and all of my closing statements. And so with that said, I'm going to move the chat to my main screen and make sure that we chat about whatever is on your mind or whatever questions you have. And so for our guests specifically, not our partners or our team members that are on today, but for our guests specifically, do we have any questions regarding the content we talked about today or the topic? All right. I just see a lot of great comments. Do we have a checklist or cheat sheet? So I would encourage you, because everybody's checklist is going to be just a little bit different. One size does not fit all. So if someone invited you to today, I would get with that person, and absolutely there should be a checklist. Everybody needs a reference, kind of a beacon, to kind of go back to and drill back to. So we can absolutely provide that to you, but I would suggest that it's custom to your situation because it could be really overwhelming if it's a general checklist. Okay, I think I answered questions. I can't see heads shake. All right. It's all quite clear. I love, love, love. Okay. Well, I think I've done my job and I've served everybody well, and I've given information that you feel is helpful and useful. If for any reason you have questions after, oh, wait, Michael says, wait, I have something to say. Oh my goodness. What do you have?
Sorry, I was just wanted to say it's a really good seminar and I really appreciate your time.
Oh, I love it. You've been wonderful to have today. Thank you so very much.